Talk a little bit about why you think there's a major volatility event coming, especially as we head into an earnings season, in which expectations are extremely high.
Hi, Deirdre. Good to be with you. Well, look, I mean, when Jeff Bezos is launching into space next week, maybe he can take a picture of the NASDAQ for us and bring it back. The index has been on a nonstop run. We're on the 9th week up. What's really interesting here is that, usually you would want to see an army along with the generals, but the generals are again completely on their own. The internals of the NASDAQ in particular have been getting weaker and weaker and weaker from high to high. Today, speaking just of the current market here, as the NASDAQ 100 hit 15,000, there were only 6 new highs, new lows, right? So the trends are intact on all of these. But when you look at the underlying volatility index of the NASDAQ, which is called DXN, it's actually building a very clean pattern. And surprisingly, on these last new highs, it has not made new lows. So this pattern is building, it continues to build. And to the extent that these big cap techs that are now reporting cannot sustain new highs, and they all have upside risks, I totally acknowledge that. But if they cannot sustain these new highs, and given their predominance in the indices, that may be setting up for a sizable reversal.
Right, and Sven, you're looking at this from a technical point of view, but from a fundamental point of view, you do note that valuations are extremely stretched. You note that they're higher than they were at the peak of the 2000 bubble. We talked to a lot of guests about this, and many of them argue that it's not the same. You've got more bulletproof balance sheets, better companies coming, better quality companies in terms of listings, massive cash piles, and those strong fundamentals. So what's that telling you?
Well, it better be different this time, right? Look, in May, Neil Kashkari, the head of the Minneapolis Fed, actually said something very interesting. He said, all my Wall Street friends are complaining that their trading models no longer work. You just mentioned the valuation. On a price to sales basis, tech is now over 7, which is higher than 2000. The S&P is over 3.2, which the general trend has been 1.5 to 2.0. It better be different this time because there's absolutely zero history of any of this being sustainable. And in terms of fundamentals, yes, we've just seen trillions and trillions and trillions of dollars in artificial liquidity from the monetary and the fiscal side. There is a natural economy beyond this, and we don't know what that looks like. And it looks like if you're looking at general data coming in, there may be some peaking going on. So you're going to transition from a period of peak recovery growth to something more natural. And then you better have a story to back these valuations up. I mean, you can maintain this, obviously, during this liquidity phase. The question is what comes after.